Hey, this is Trader Travis, and in this video, we're going to teach you about an option strike price. And you'll also learn how to avoid the typical amateur mistake of picking the wrong option and how your profits will suffer because of it. And then you're going to learn precisely how the strike or exercise price affects the stock option's value. Now, the strike price, here's a technical definition. The strike price or exercise price of an option is a price at which the stock will be bought or sold when the option is exercised. Now, I'll show you some visual examples of this in a second so it'll make more sense. But as an option trader, I hardly ever have to really deal with exercising options, but it's still important for you to, know what the strike price is because it's a key component of whether you'll make or lose money. So what I'm going to do now is pull up my option chain so we can, dig a little deeper here by looking at a stock option chain of Starbucks. Now, real quick, we have a lesson on the site that kind of goes through and explains fully what an option chain is, and we'll define, all of this for you. So I won't spend any time explaining that. That lesson here is on this website here. I believe is in module 6. If you scroll down, you'll see the lesson on the strike price. And so let me just go ahead here and get back to this option chain and then show you what the strike price is. Now, again, the strike price is, often called the exercise price, and here's what that means. Starbucks is currently trading at $48.70. Now, we have a couple options here. We have a September 48 call option that calls on the left side, puts on the right side. So this is the strikes. If you can see here, you see strike here. So these are the strike prices. So these are the exercise prices. And what this means is that for a call option, now this option right here gives you the right to buy Starbucks at $48. This one gives you the right to buy it at $49, $50, $52, $55. Put options are opposite. They give you the right to sell. So the 41 will give somebody the right to sell it at $41, $42, $43. Okay, so that's all the strike price is. It's just a price. It's a legal contract. Options are legal contracts per se. And so these contracts give you certain rights. And these are the rights that these contracts give you, either the right to buy or sell something. Now, there are 3 terms that will describe the strike price's relationship to the stock price. And that's in the money, at the money, and out of the money. Now, those are foreign concepts to most people, so let me explain. In the money. These ones here shaded in gray, dark gray, are in the money. And what does that mean? Well, they're profitable. And think about this one. This one gives you the right to buy Starbucks for $44, and Starbucks is trading at $48. So you get to buy it at about a $4.70 discount. So you're making money. It's in the money. And so there's some profit built in here. Okay. Out of the money means just that. You're out of money. You're going to lose money. All right. This one gives you the right to buy Starbucks at $55. All right. Why would I buy it for $55 when I can easily buy it on the open market for $48? And so essentially you're paying like $7 more. So you're going to be out of money. If you bought this at $55, you'd immediately see a loss in your broker account because the broker is going to represent the current price at $48. You bought it at $55, so it's going to show you're actually down about $7. All right. So you're out of the money. That's why these call it out of the money. Now, at the money is a sweet middle spot. It's right directly at the money. You're neither really making or losing money. It's at the money. Okay, so it's like an even price. And at the money options are the ones closest to the current price. It's not going to be exact because the strike prices are usually whole numbers. And you see the stock is trading at $48.70, not $48. But this $48 would be considered at the money. Well, actually, no. The at the money ones are the ones closest to the current stock price. So it's actually $49 because 30 cents, $48.70 is closer to $49 than it is $48. Now, before I go, I want to teach you about some of the typical amateur mistakes I see. And, there are 2 camps or 2 different types of option trading. It's the buying or the selling side. We won't have time in these short videos to cover both. So let's just think about the buying side. When people come in, they hear about option trading. They can hear you can make like 50, 100% return on investment, retire like a millionaire in a year. Yeah, right. But anyway, that's how people approach option trading. And then they come and they see this option chain here and they're like, which one do I pick? You have 1, 2, 3, 4, 5. You have like 7 different months you can pick. If you open just one month, you have hundreds of different options options. They have no clue, right? And then they say, well, let me just look at some of the prices here. And they look at these ones. They're like, wow, these are only 42 cents. Wow, I think I'll pick those ones. And they want to buy those ones, or they might come here to September and say, wow, they're only $1. Okay, compared to these ones, if you come all the way out to April, you can see they're about $4. So they're like, man, I'm not going to pay, $4 or $5 when I can get one for like 40 cents. And so they'll go ahead and buy the cheapest option because, that's what they heard, that, hey, you can make a lot of money. And they also heard that, out of the money ones that are best to buy because, you get such an explosive movement. And these are the ones where you can get like a 2,000% return on investment. And yes, I've seen that before in my own trading. However, it's a typical amateur mistake because there are too many things to think about. They don't realize that your strategy will dictate which option you pick. For instance, if you're a stock trader, most stock traders pick in the money options. And I'm going to get technical here. If it doesn't make sense, so you don't worry, as you go through the lesson on our site, this will make sense. But the reason stock traders often pick in the money options is because they have a high delta. They have a delta of about 1. And so they'll get a dollar for dollar move with the stock. So they have a choice. They can buy 100 shares of Starbucks for about almost $5,000, or they can come here and spend 500 and still get the same percent return on investment. Okay. Strategy will dictate that. So a stock trader strategy will be probably to pick a in the money option or high delta. A speculator, somebody who likes to gamble, yeah, they might pick out of the money. And whether they pick these weeklies here or whether they pick the September or October will all depend on how long they plan on staying in that trade. And so there are a lot of things to think about. And if you're a conservative person, kind of middle of the road, you might just pick at the money one. And so the typical amateur mistake I see people is they buy front month options, which are the ones that expire 28/7. The front month, the ones that expire the soonest, and they buy out of the money, really cheap ones. And unless your strategy is to really gamble and have a potential losing all your money, that's completely the wrong strategy. And, in all defense of amateurs, I was there. There's just way too much to consider. And it was the type of things I didn't consider and didn't realize when I was trying to self-educate myself by learning for free. It wasn't until I actually took a course and I had a mentor that I learned how to properly evaluate, which strike price is the best to pick. And, when is the best time to pick it? Because there's a lot of different variables you need to consider. And again, this is just the buying side. There's also the selling side. And so if you're selling options, which strike is the best? So you have two different sides of option trading and then, the buying and the selling, and each one has their own variables of which option is the best to pick. And so I got to run. This video is getting just a little bit long. So that's it for this particular lesson. We'll record more videos later. But if you want to be notified of when we post more lessons or, when we maybe even run another coaching program so we can walk students step by step through this, just subscribe to our YouTube channel or click on the link below. So you take care and I'll talk to you soon. Bye.